Hi, and welcome to the way that we treat the difference between the tax charge per the income statement and the tax payment per the cash flow statement. All right, in order to do this, let me just take you through a little bit of the way that the system works. First of all, what we notice is inside the January period, or the January budgeted period, we have a tax charge of $7,118. So that is really just the charge that we place against the income statement. However, in our current liability section, if we open up that detailed window, we notice there is an item called tax payable. Okay, it really doesn't matter what the description is. However, it does matter how it's being classified. So I classify this as a tax payable element. All right, so this helps the system know that this relates to tax payable. Is in the December period, there was $55,000 of tax payable. In the January period, we have an accrual of about $7,118. So that is the accrual for the current period, which ultimately means, in theory, that cash flow should show a $55,000 worth of cash payment for tax purposes. Let's see if that is the case. I'll exit out of there, go to my reports, view reports, and we'll go straight into the cash flow statement. Now, the cash flow statement tells us at the January, or during the January period, we have $55,000 worth of corporate tax that we are physically paying, even though the income statement shows a charge of something very different. All right, so now how do we make this all happen, and how does it really help us to get the cash component and the charge component sorted out? So let's go to the February period and see how we can do that. During the February period, as you notice, we have a $32,000 worth of a tax provision. Now, the way we got to that provision when we did our budgeting, and there is a budgeting section on one of your videos, we go to the profitability box, and there you can see I have made a provision for tax of 30% on my pre-tax income. Of course, if I want to change that, I can make that 35%. So let's say we want to keep the 35%, and now we have a provision for tax of $38,000. However, we're only going to pay that physically sometime later than the February period. So I'm going to press update, and then automatically that change is going to happen inside my income statement. Now, the thing that I have to do on a manual basis is then look at my other current liability. And my other current liability shows now that I have $7,000 worth of provision in the previous period, and I have a $39,709 provision in the current February period. Now, going back, let's have a look. There should be a total provision of $7,000 plus $38,000. So let's see what my total provision should look like. I'll go to my quick calculator. So it's going to be 7,118 plus the current charge in February, $38,023. So my provision should be at the end of February, $45,000. That's if I don't want to see any cash payment for taxes for January and February. All right, let's have a look and see. Let's make that adjustment. 45,141, and we quickly go to our other current liabilities, and we change that to 45,141. And press the exit button. It automatically saves it. And now we see we have a difference. All right. The two ways that we can fix that difference, we can just simply go to our scorecard. And, this is the quick fix. Just click on short-term debt, and then it automatically fixes it. And there we are in a corrected situation. So now let's go and have a look at our cash flow payment. I'll go to my reports and view print reports. And once again, go to my cash flow statement, press OK. And here we should notice that our tax payment, which is there, was $55,000 in January, which was the provision that we had at the end of December, which we had to pay, and no tax payment in February. So hopefully that solves the problem of the difference between a provision for taxes and the related cash payment for those taxes. Have a great day. All the best.